Okay, thanks for being here, everybody. I'm the partner in charge of the Tax Controversy and Procedures group, and today I have with me Margarita Stone and Elise Katz. Elise was going to be a presenter, but she's gotten sick and her voice is giving her problems, so I'll be handling her slides today, but she'll be manning the chat box as we go. So this is our information here, and I'm feeling a little bit under the weather, but I've got my drink here, so I might have to drink a lot. But I guess Elise from Phoenix has got me sick somehow in Utah. But I think Margarita's fine, right, Margarita? Okay, just a little bit about us. So I'm a former IRS attorney. I'm an attorney by training. There's 18 people in our group. We have former IRS employees, including me and Elise, and another attorney in the group is Margarita. So we handle anything from penalty abatements, collection issues, and IRS examinations, of course. And that's what we'll go through today. Elise is she's a former revenue agent, so she handles a lot of the IRS exams. I handle a lot of those as well, but we all kind of handle everything in our group. And Margarita's in charge of our collection area, and there's several people that work for her there. She'll be going over a lot of that today. So first, I'll go over what Elise was planning on going over, and that's just basically IRS examinations and some procedural changes that have been going on, things that we get lots of questions about. So today we'll go through the IRS updates, exam campaigns, kind of some things that we're seeing. The main one we're going to talk about is we're getting a lot of S-corp and actually partnership compensation issues, and then also some appeals issues. So for the IRS updates, now, of course, during COVID, the IRS was sort of hampered in that they are a bureaucracy that's kind of been run on 1970s equipment for a long time. When I was there was a lot of problems trying to get the information that you needed and what you needed to do to find out the data that you needed to complete an exam. And then during COVID, all those agents and everybody were sent to work from home, which is not something that the IRS was as quick to do as maybe some of us in private practice. And so everything got delayed. And also all the campuses that process your returns, they just was no one there to process them. They get a skeleton crew in later, but those problems and a whole bunch of retirements have set everything back. It's made it so that antiquated system is stressed even more, and we have to spend a lot of time just trying to get a person to talk to every day to resolve problems. Elise notes here that they're trying to hire employees, but imagine how it's been hard for us to hire employees with the changes in COVID and lots of different things going on. They've had an even more difficult time. So typically they've always said that the tax gap. Now the tax gap is sort of this amount of money that the IRS thinks that taxpayers are avoiding, incorrectly, and usually it would hover around 300 billion or something like that. And now people say it's around $1 trillion because of that. So the IRS to try to remedy this, they've started a bunch of new IRS campaigns. They've changed some processes. We'll talk about the BBA and the TCGA. The BBA is a new partnership audit regime and some of the other problems that have been created by the pandemic. So what we always like to start out with is an exam. People are always asking us kind of like, what do you do in the exam? How do you control it? Because seemingly there's not much leverage when you're dealing with an IRS agent that has the ability to ask you for any records or information that they insist upon, or they can summons third parties, and they can do a lot of things that can be obtrusive and difficult. So we have some sort of guidelines that you use. You don't have to just sit there and take it. And so we point out a lot of these things. Like, we like to use the meetings to get more information from the agent than they get from us. So we want to know what's going on. Why is this investigation going on? Why is there group is the agent in, what's their end goal? So we're always asking those questions to try to figure that out. And we usually will drive them to put things in writing, because we find a lot of times the agents tend to misconstrue things that are said verbally. Now, the only leverage you really have is the statute of limitations. Remember, all these agents have hundreds of cases they've got to try to get through, and it's difficult for them to complete them. They have a limited amount of time each case. So a lot of times they'll ask, hey, can you extend the statute of limitations? And we always say, well, that's the only time we get to bargain, right? You want more time to do your work, then we need something in exchange, like, can you complete this by a certain month if we give you more time? Things like that. Now, the most important thing I think is when you respond to things, you want to make sure you use objective facts. The IRS is always trying to get subjective facts, like why you did something. But I think the key is to focus on giving them the objective facts. Those are just the who, what, not the why, but the who, the what, and the where, so that you can get those posts out there and argue around the facts. Some other things on here, if you don't want information, we can provide them for you. We have a lot of to cover. So like I said, we like the written responses. If you have an issue that the agent just isn't getting, and you know you're right, you can ask it to be elevated to chief counsel. It's their discretion to do so, but sometimes that helps resolve something that's stuck in exam and they're just not getting it because they're not used to it. Okay. So some of the things that the IRS is focusing on after COVID, they have gone to sort of a campaign type of arrangement where they get a group of agents, they specially train them to deal with just a certain kind of issue. And so these are some of those that they're dealing with: foreign tax credit, 355 transactions, DPAD deductions, foreign earned income exclusion, the 1120F non-filers. Then there's also the global high net worth campaigns. We're seeing a lot of those. That's where people that have more than $10 million in assets, the IRS is auditing them in sort of a broad scope and going into different entities. There's other things that obviously the micro captives are still a problematic thing for the IRS. And as always, offshore private banking or offshore credit card transactions or any of that stuff, that there's a lot of abuse. I dealt with a lot of that when I was with the IRS. Related party transactions, but some of these are more common. These campaigns, basis issues of all kinds, partnership and S-corp basis, and then with S-corps, a lot of the tax accounting that they think is not done correctly, and especially around compensation and how those distributions come out and whether that causes losses in excess of basis, etc. Conservation easements, also constant hot topic. We haven't seen as many exams, although they threaten them, because I think most of those agents are focused on the syndicated conservation easements, and they're spending all their time there, so they're not, spending their time on the one-off donations of land by a single taxpayer. These are more the syndicated partnerships that everybody puts money in and they donate a piece of land. And then of course, the TCGA campaigns and the virtual currency. Virtual currency is hard for everybody to understand. The IRS does not have a grip on it yet. So there's a lot of information coming in from the people that keep the data for virtual currency. And then you kind of have to fight over what it means because it has a lot of nuances. All right, so the BBA, the Bipartisan Budget Act. So this is important to us because it's kind of changed the landscape and we're all still trying to figure this out. We have several examinations where this is in play, and we find that the IRS is trying to fit round pegs in the square holes and different things, trying to stick to kind of how they did it with TEFRA. We can't get straight answers sometimes, but what it is, it's a new audit regime where essentially the partnership becomes the ultimate taxpayer and would pay the tax. Now, in some cases, you have to be a BBA partnership. Sometimes you can opt in. So that all began with the changes in the law in 2017. And so you could actually elect in sometimes, even if you weren't a BBA partnership, to have this sort of treatment. When does that make sense? Most people don't want to be under this audit regime. It's something that should favor the IRS, but maybe It's just more convenient to deal with the tax at the partnership level. So we have done that in cases where it just makes sense to put it all under that. That's what the slide's saying here. Everything's done at the partnership level. You don't have to have all this stuff going to all these computations and everything with the partners once the audit is done. Under TEFRA, you had to go through that whole process, and it had a lot of mistakes and a lot of work you had to do to check the IRS. So then here's how you get into it, right? So of course you might be able to elect out of it on your return, but it started happening is just you're automatically in it unless you elect it out. So that's what happened in 2018. You have to be qualified, have to be a partnership that can qualify as a non-BBA partnership. Otherwise, you're automatically in it. So most people elect out, and that seems to be the prevailing advice. Now that's when we go through exams, then of course that all pushes down to the partner level. And the partner statutes come into play, and there's none of these extra additional notices and things that need to be done. To do that, partnership must have 100 or fewer partners, and the partnership must only have eligible partners, which is a little different than TEFRA. It used to be pretty much anything that was not a normal individual would trigger TEFRA, but eligible partners are individuals, C-corps, foreign entities that would be treated as C-corp, S corporations, and estates of deceased partners. So, and it needs to be timely filed for the election. This is the roadmap. It is more difficult and confusing than this seems to be. So you see there's a lot of, ooh, if this, then that kind of situation. The main thing here for us is this part. This is like all down at the bottom, the 270 days portion of that slide. It's basically a whole bunch of stuff goes on there, and in a lot of cases we're just waiting for the IRS to do a whole bunch of things in that time frame, and we don't get much response. It's kind of a very unknown type of situation, but this slide is helpful if you go through one of those. So that's the BBA. I know that's a quick run through of it. I don't know if there's a questions about that. Let's see. Oh, Lisa's just pointing out that there's a lot of training cases because there's new agents. So you got to have all these training cases. That kind of takes 2 agents, right? Because they have to have what are they called, OJI, that's training them, overseeing everything that they do. And unfortunately, those can be more difficult than other things because these are new, eager agents trying to find something, don't understand a lot of complex tax issues, so they can make assumptions. They'll just read the basics of the law and they don't know all the nuances. So, all right. So let's say we get through the exam. We don't have a BBA. It's just a regular individual. There's different ways to what Elise calls here close the case. So there's one where we just get a no change. A no change is that they said something was wrong, and we gave them some documentation, and she calls it hashtag winning, but that means the original return was correct and they agreed to it. It's called a no change. No change with an adjustment. That can be like an agreed upon adjustment between the parties, but essentially no difference in the tax, or definitely no penalties. You can have agreed, like maybe there was a mistake. Oftentimes a 1099 was missed or something, and we'll just come in and agree to it just to make sure there's no penalty. Now, if it's unagreed, then you got to do something about it. If you don't agree with the agent, and oftentimes this happens for some reasons that they just they won't listen, they won't consider the arguments, or they're just really stuck on the intent of the taxpayer, or facts they just can't get past. So you might have to you could go a couple ways to close the examination. Now, this isn't close the case, like it's going to go on, but so you could have a formal protest for appeals. We call this a 30-day letter, or appeals protest on a 30-day letter. This will send you directly to appeals. You have to have a long time on the statute of limitations to do that, so you have to agree to extend. For that reason, we don't like it too much, because with COVID and all the delays, it could sometimes be years before we get heard, and everybody loses track. It's hard to follow up, and then when the appeals officer does pick it up, they just look at it quickly and they don't give you a chance to explain or have a true hearing. For years now, we haven't been able to meet with them face to face, which we think is a disadvantage for taxpayers when you don't get to sit there and explain it and go through it. They kind of cut the calls short and don't want to talk much. And they're working from their houses, so different things are distracting them. So what we like to do is go unagreed docketed appeals. So what we'll often do is file a tax court petition so that we can still go to appeals, but it's got a shorter time frame. The IRS has to deal with it because they've got the court side in the background. And if they don't finish it up, then they kind of get in trouble for not settling the cases. And so we have to work with them quickly, but usually we get 6 to 9 months to get an appeals memo to them and then have a hearing. So they might not talk to us for 6 of those 9 months, but we can start talking and get it going. So there's other ways to close it. So another one is if you have an amended return, you're asking for a refund claim. Sometimes you might still go through an unagreed process, but you can't go to court. You have to go to district court. Ultimately, you can't go to tax court, I should say. And so the road to appeals, again, there's those 2 paths. One is kind of an administrative formal process, but one is like through the court, kind of a sideways through the court. You jump into court, very easy petition to do. You don't have to do much, nothing too formal. You just have to dispute all the items they've raised. And then after that, you just go to the appeals officer, even though you filed the petition in court. Now, if you don't settle, you get a chance to go work with the IRS attorneys to try to settle the case, which actually happens quite a bit, especially with all the delays with COVID and appeals officers just kind of passing the buck on. The benefit of that is that they've got to they're not going to take a case to court that they can't win either. They'll come to a reconciliation if you have good arguments. So these formal protests, we talk about the 30-day letter. I think the most important thing I'll just talk about here briefly, since time is limited, is it's got to be a written protest with a penalties of perjury statement on it. So all these other things must be included. Everybody typically includes that. You got to list what years, what's at issue, what you disagree with, and the facts, and also any law you have. But if it's not signed, you get in a lot of trouble. They'll say it's not a completed protest. The docketed appeals, this is kind of the process there. You don't do the 30-day response. You wait until you get a notice of deficiency, but then you got a petition within that 90 days, and then you go to appeals. You'll get an answer from the IRS chief counsel, but it's kind of just a canned answer, unless it's a complicated or fraud case. So people always ask us, hey, they're asking me to extend the statute of limitations, and we'll say, well, that's our only leverage, right? So we don't really like to extend it unless we get something that's in return. So now, of course, we have to go, like if we're asking for a refund, then we need to go to the 30-day appeals process. So we're going to have to extend. Or if we need more time to get our evidence into the agent, then we might need to extend. But in most circumstances, we don't want to extend unless it's for a very short amount of time with agreed upon completion of the exam, because this is our only leverage. And also, why would you give them more time to audit you? The less time they have, the worse job they do, and easier it is to rehabilitate in appeals. If you know there's a disagreement and they're not going to agree, this is often the way to go. If you're going to agree and it's just a matter of giving them time to do computation, that's different. But all right, so here we are with IRS focused audits, and this is the S-corp reasonable comp. Probably we get the most exams that are focused on this. There are campaigns, but I think most of the agents just pick this up whenever they find an S-corp on a tax return in an exam. So just to go through it real quick, we think that a lot of people just don't understand how this works because there's no upfront consideration of how you determine your compensation when everything in this area relies on determining this upfront. So if no one remembers anything else, it's if you have an S corporation, you make sure you determine the compensation appropriately, so that you can, defend this. A lot of times what happens is these S corporations are sort of an extension of a service provider, and they just kind of treat it as their pocketbook. And sometimes they're like, why should I transfer it myself and then pay expenses? I'm just going to pay expenses directly, including personal expenses. then you realize, well, we didn't account for all those as wages or compensation. Because sometimes if that comes out, here's this section 3231E1, which is one that causes a lot of problems. It's any form of money remuneration paid to an individual for services rendered as an employee to one or more employers. But that can mean any money coming out to your benefit. If it was reasonable, then you're going to have to cover it as compensation, which of course has FICA and FUTA tax implications. So people don't like to pay those taxes, and so they think, well, an S corporation, you don't have to, but if you get picked up, then you will. And sometimes they'll assert prepared penalties and different things against the people who prepared the returns if they didn't follow the rules. All right, so here's what you got to consider. Training experience, duties and responsibilities, time and effort, the dividends and distributions, what compensation agreements. I've never even seen one, hardly. They should exist though. Like if you're going to give a bonus, you should have a meeting, even if it's with yourself, to explain that. And then comparable business pay, timing and manner of payments. Okay, so I'm going to kind of skim through to try to get to where the problem is. Right now, the IRS wins all these cases 25-1 in reasonable compensation cases. This one that they say is a win is Davis. It's a split decision because their husband was an officer, but he only provided minimal to no services. So there it ended up being a much smaller adjustment because there's specifically statements in that, if they're an officer that doesn't perform much work, then their reasonable compensation should be much lower. So the other case that's very famous is Radke, because this was a law firm, a service provider is what we constantly run up into. He withdrew $18,000 in dividends, but didn't pay himself any compensation. So this has kind of started the whole, well, you got to figure out what that reasonable compensation is to get to something, because that's, you can't just have, oh, I got an S-corp, I don't have to pay employment taxes. IRS won that case because the court said the dividends represented wages and they were subject to payroll taxes. And he was the only director, and he was also like the only employee, only significant employee, and he didn't pay himself any salary. So Radke's kind of the posting point, and Spicer involved an accountant, same situation, very low pay. He was the most significant revenue source in the firm. So Ninth Circuit kind of built up this whole arrangement where, here you go, 3121D defines an employee for payroll tax purposes as any officer of the corporation. And because he was the president, that was obvious he was going to be an officer. And so Ninth Circuit held that since he was the only CPA, and the only person that could sign the tax returns, he had to be doing something for pay. And they determined same thing like they did in Radke, his reasonable compensation. So these are the kind of things the IRS looks for, but I'm trying to get to some other more explicit things that problems happen. How many employees do they have? What kind of services do they provide? What impact does that officer have? Are they the ones that derive all that revenue? Or can they even provide services if that person isn't there and licensed? How much time do they actually work? How do they get the compensation? So here's the best practices that we've come up with, right? You need to do a prior to year-end analysis. See, even if you haven't been paying payroll taxes all year, there's ways around fixing that. And the IRS doesn't care if you can even put it onto the Schedule SC of your 1040, and they don't like it, but as long as you lump sum paid it and paid your self-employment tax there, they don't have much to argue against. Now, you don't want to have no wages. You got to have some actual consideration. And now they may take money from the business and they think, well, that's not compensation. A lot of times what people say is, hey, I'm losing business. If I take a salary, it's just going to lose more money. And then that's less income that flows through. But there's problems with that. But one thing I'd like to point out is CPAs aren't qualified to determine reasonable compensation. So then you say, well, wait, the IRS is telling us we have to make sure we check all these boxes. But then if you're a CPA, preparing a tax return, you can't even decide what it is. So you've got to obtain expert advice. That's essentially the way it works. There's various software products where there's a whole bunch of professional advice behind it, and you can put all these inputs in, and it plugs out what your compensation should be. You can go straight to an economist or a compensation expert. There's many that will do it for a reasonable fee, and some people could rely on that for years to come. And then these are the important things to check. So one I think people forget is in the 1120S instructions, it says distributions and other payments by an S corporation to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for certain. Okay, so that there's a reasonable cost compensation statement, right? So it's not like it's something you can walk past. It's in there in the instructions. People can't argue they weren't aware because it's right there. That's why that statement is there, so they can hold people to it. And of course, it's the value that an ordinary, typical, well, someone would really contract for this. Now, also in the notice of acceptance of an S corporation, they warn you again. They say taxpayers and Chapter S shareholders need to be aware of 7444. The reason why they need to be aware of that is that they need to know the IRS can recharacterize corporate dividends to become salary. Okay. So remember, there you got those instructions. This means any other payments. It could be personal expenses, shareholder loans that can be reclassified, payments made to family members can be reclassified. Shareholder loans must be bona fide. Now, this is the main problem we have. We get people that say, why do I need a note between myself and my S-corp? Well, that's the case law says, well, it's got to look bona fide. You got to have a promissory note. The IRS does not like AFR rates on these notes. They want you to charge a market rate because that would be bona fide. Got to have security, you got to have collateral. Maybe you surrender something that, if you make contributions, you'd have to surrender them if you don't pay it back, or vice versa. And actual repayments. Now, we've had many cases where interest was just accrued and payments were sporadic or lump, and we won those cases, but it's an uphill battle. So just be aware, it's better to be repayments according to the note. And if you're going to take another loan or something, you want a new note. You could bring them both together, but it needs to be there. So this glass blocks case is one that kind of pushed through that note problem. This was a good year for this S corporation for Frederick Blodgett. He had $877 in net income. He'd put $45,000 in during the year of his own money, but he transferred out $30,844 in payments to himself, including personal payments for home and auto. So he was like, well, I'm not going to pay myself salary because that's just going to create a loss. He took the position that the transfer in was a shareholder loan to the S-corp, and the payments out were repayment of the shareholder loan. So the court found no bona fide loan. You don't have a note. You weren't even accruing interest. You didn't have any security, and you weren't making any payments. So this is sort of the one you got to watch out for. Now, we've had some with better results, and there are better cases because shareholder loans cover not just S-corps, but the expanse of many business entities. But this one is, the situation I hear a lot. Well, I'm not just going to pay myself a salary so I have a big loss in the S-corp. And the IRS will say, well, yeah, you got to pay yourself your salary, pay us the employment taxes, and then you can take your loss. All right, so a lot of people say to me, here's polling question 2. How do you determine S-corp salary of officers? This is asking any of you that do this. If you don't, you can say D, I don't deal with S-corps. But the other options are A, use an expert or software, or B, use the Bureau of Labor Statistics. That's foreshadowing. Or C, use the FICA limit. All right, so while you're answering that, I'll discuss it a little bit. A lot of times the agents will say, hey, as long as you're paying your reasonable compensation up to the FICA limit, I don't have a problem with it. But we're finding more and more that is, that's a very informal thing. I used to use that as a guidepost when I was with the IRS because it's just easy to get there. But a lot of times now they're going after additional Medicare tax. So you have to be wary of that. We have a lot of doctors, lawyers that pay themselves far in excess of the FICA limit, but then they only pay, but they're the only ones that derive the services, and the IRS will take the position that no, all that money should belong to you because you're the only one that derives the services. It's all compensation for your work. So that becomes a difficult argument. Here are the wage limits. So in 2022, it's bumped up to 147. Yeah, every year we pay more in FICA, but this doesn't always work. You just have to be, you can't advise people that, oh, just pay the FICA limit and you'll be fine. Technically, there needs to be a reasonable compensation analysis done. All right, Bureau of Labor Statistics. Why did I bring this up? Because the IRS always uses this, and it's basically invalid. So it's an easy way for them to kind of figure out, not without picking a number out of the air, they can figure out, well, what would this person be paid? And so they'll go into the BLS statistics place, and sometimes they'll have IRS person inside that's more sophisticated and we'll do a little report on it. But and they'll show them, basically they'll put in a certain type of job, they'll equate it to this job, and then they plug it in and say, well, how close are they to this kind of same, what's a revenue and a similar size revenue? They'll just throw out all these numbers. The IRS doesn't use these in court. Like if they have tried to fight small cases with this, but the court has said, well, this isn't, this isn't an expert. So in those cases, they've got to go get an expert too to determine what the compensation is. So you can't really rely on it either, but a lot of times if the IRS pulls it out, a lot of settlement goes on based on those numbers. Why do we mention all this? Because the IRS has been really pushing for preparer penalties on this. It's important to have the process documented. If you're a tax preparer, how you determine the reasonable compensation. Usually that's going to the taxpayer and saying, how are you going to determine reasonable compensation? If they don't know, you can guide them to some places where they can get it. But the answers can't just be, oh, I'm losing money, I'm not going to pay myself wages. So that is important to remember. Document what is going on, because basically Circular 230, even though it doesn't let you determine what compensation is, it makes you the gatekeeper to it, and then it must be done. You got to be proactive if you're a preparer. You have to go ask the questions that would lead to, well, how are they making ends meet? I don't know that they really have to ask that question, but that is one that IRS frequently says, if you didn't ask, they think they could run up preparer penalties, that you're looking the other way because you would have known, seen their bank records, that they're just pulling money out of the S-corp to survive. Anyway, documentation, best way to go. Make sure that conversation happens and you document it so that you aren't subject to that. If it's your own S-corp, you want to make sure your preparer does this as well. And if you should be wary of the lower salary, because the IRS they do not like, because of those warnings I showed you in the instructions, they don't accept that as a reasonable analysis by a practitioner to advise you not, to have a much lower salary, because they're not even capable of doing it. Plus there's the warnings. And so they're pushing you to get a sophisticated analysis done. All right, well, that's the end of my part. So I'm going to turn it over to Margarita and let Margarita tell a little bit more about herself as well. And I'll check through the chat while you're going.
Okay, thanks, Ben. So my name is Margarita Stone. I am an attorney, and I work for IRS. I'm out of the Rancho Cucamonga office. And so like Ben said, I will be talking today about collections and penalty abatement. So collections, I mean, there's no one size fits all. So collections, every client is different, their case is different. We look at a lot of factors. There's different types of resolutions for all clients. So obviously if a client can full pay their balance due, great, that is a resolution. Obviously, pay your taxes. Another resolution is if, believe it or not, if you don't prepare your tax returns, the IRS can prepare a return for you. And when they do that, the IRS only knows really the income information that was reported to them by third parties. And so they don't know the specific details of a taxpayer on, whether they're married, how many kids they have, any expenses that they may be able to deduct. So you're being taxed really at the highest rate. So sometimes by just filing an original return, that's a resolution because that will most likely reduce the tax liability. Not always, but most of the time. A client can come to us with a bank levy, a wage garnishment, depending if they're in compliance or not. So if they're not in compliance, step number one obviously is dealing with that levy situation. So that's a type of resolution. Liens, and that's actually been very popular lately just because the housing market has been really hot. When in 2020 with COVID, the interest rates were really low. So a lot of people were refinancing. So if there's lien filings on property in order to sell that property, there is a process we go to get that lien discharged. And if you're trying to refinance, that's a lien subordination. Currently not collectible. So if a client is having financial hardship, we just have to prove that to the IRS, and they can be in that status for approximately 2 years before the IRS will review their situation again. Installment agreement. So they're streamlined installment agreements in which no financials have to be provided. If balances are over a certain amount, then we do have to provide financial information. But that's a resolution, obviously, if a taxpayer cannot full pay. An offer and compromise. Not everyone qualifies for an offer, although everyone wants a settlement. That's based on the financials, their ability or inability to pay. And again, every case is different, but based on the numbers, if you qualify, we would submit an offer and compromise. Penalty abatement. So if you do not qualify for an offer, an option is to request that the penalties be removed based on, sometimes it's based on the client's history. Most of the time it's based on reasonable cause. And then bankruptcy is a resolution. Internally, we say, if someone is thinking about bankruptcy, contact Benjamin Peeler. But at the end of the day, it's probably you need to see a bankruptcy attorney on that. Okay, so something that's, I guess, really popular is, during COVID, a lot of businesses shut down, but they kept their employees on payroll. But some of them, some people, they're more concerned about keeping their employees and, that they can keep their jobs and let me make payroll. However, there's not enough money to turn over to the IRS to make their deposits. So when times are bad, everyone wants to do the right thing in a sense, like I said, keeping people working. But the downside is they're not paying the payroll taxes, and the IRS gets super aggressive on those issues because they say, you're holding those funds, you're charging your employees because you're taking out of their paychecks, the federal income tax withholdings, half of Social Security and half of Medicare because the employer has to match the other half. But they're saying that was never your money to begin with. You're holding it in trust for your employees, and you should have turned it over. The IRS is not a lender. You can't just, borrow money and it wasn't your money to begin with. So the IRS gets very aggressive about that, and then they go a step further and they want to do what they call is the trust fund recovery penalty. There is an interview process. It's the 4180 interview, and they're trying to determine who are the individuals that are responsible for collecting or paying the taxes, and was it willful? These elements, for the IRS to prove it, it's not really high thresholds. If you're an officer, they could say, okay, you're responsible. If you were the bookkeeper, if you signed a check, and they can hold multiple people responsible. So it is a process the IRS goes through. It's more, it has become a standard procedure. because if the business closes, they've already done that investigation and now they have another source to collect from, which is you individually. And if you can't pay it, they will file tax liens. Again, it gives the IRS two sources to collect from, the business and the individual. Things to remember just overall about collections is you just have to remember, the IRS's job is to collect. The IRS is not your friend. Some agents or revenue officers, some of them are nice and they're okay to deal with, but that's a strategy. That's a strategy for, for taxpayers to let their guard down and then just, disclose all this information, which may not be in their benefit. So just kind of keep that in mind. There's some revenue officers that are super aggressive. Some are bullies, believe it or not. So it all depends who you're dealing with. But again, just know that at the end of the day, their job is to collect, and they will, some are more aggressive than others on how they choose to do their job in collecting. But keep in mind that, there are tools out there. You can always, well, not always, but if a client receives an intent to levy notice or a notice of lien filing, you can request a collection due process hearing. That's a form 12153. If you're having issues with the service center or a revenue officer, you can always escalate it to a manager, even their manager, which is a territory manager. There's collection appeal rights in certain situations. So a proposed levy, if they're threatening to seize, if they're rejecting or terminating an installment agreement. You cannot have two appeals at the same time. So you can't have a CDP and a collection appeal request at the same time. But just know that at least one of them is an option. And tax court, if you're in a collection due process hearing and you feel that the person abused their discretion, that is another option, is to file a petition on the notice of determination. So just keep in mind there's tools that we can use, to protect your client from any enforced collection action. Penalty abatement is another big topic. If you do not qualify for an offer, like I mentioned earlier, the taxpayers like, hey, can I save money by, possibly getting some penalties removed? And so there's different, so one is based on your history. One option, it's called first time penalty abatement. The IRS generally looks back 3 years to see if you've always timely filed and paid on time. And so you can qualify just based on your history. And then if, let's say, you have already used that one-time abatement, there's other reasons that the IRS can waive the penalty, and that's based on reasonable cause. So common reasonable cause are things that are outside of the taxpayer's control that basically, life happens, so life happened and, they're more focused on that rather than let me file a tax return by the April 15 deadline, or I didn't make this payment. So some of those examples are, if you had an illness, a death in the family, COVID-19, no one anticipated the pandemic was going to happen, which shut down businesses, a natural disaster, so tornado, hurricane, earthquake, reliance on a tax professional. So, if you've sought the advice of an expert and you relied on that advice, that is a basis to say, hey, I relied on this person and I, didn't file on time, but I thought I did because the person told me that they filed the return on time, but for some reason it didn't go through. So that's one of the reasons for reasonable cause that we can request penalty abatement. Reliance on IRS advice, unfortunately, can't be verbal. Usually has to be something in writing. Small partnership exception, for small partnerships, if the return wasn't filed, but let's say the individuals filed, it's under 10 partners. The partners filed on time, claimed all the income, then the taxpayer may qualify for relief of penalties in that situation. In regards to penalty abatement, again, the IRS's focus is one, the taxpayer's history, two, establishing reasonable cause. And, the IRS gets so many requests for penalty abatement. So the more details, dates, and documentation that we can provide to the IRS, then I would say, that increases the possibility of getting the penalties abated. Because if we can show, for example, if there was a death in the family, how you were really affected by it, provide a death certificate. If you sought counseling, for that, if that person was the major breadwinner and now you're struggling to, make ends meet, all that could be included. If someone has been ill for a long time, they want medical records, hospital bills if you have that. So anything that can support what we're saying increases the likelihood that we can get the penalties removed. And then here's just the code section that we provided, 6651 and 6652. Okay, so tax liens. Again, like I said, during COVID, the interest rates were low. A lot of people were refinancing. And, the housing market has been hot for a while. So a lot of people are interested in asking questions about, hey, I have a federal tax lien. How do I address it? Some people think, hey, I can't sell my house because I have a lien on it, but that's not the case. So a lien arises when a person has a liability, so they owe taxes. The IRS has made a demand for that payment and taxpayer just hasn't paid it. So in reality, the lien exists. It's called a secret lien. But then the IRS files a notice of tax lien filing. And then that becomes public record and puts others on notice. A lien is not them taking anything. That is a levy. A levy is a taking. That's the garnishment or a bank levy. A lien is filed to protect the government's interest. And a lien can be released if the taxpayer full pays the balance, but you have to give the IRS at least 30 days from when the payment posts to the account that lien will be released. And again, if you're trying to sell, there is a process. You would submit an application for a certificate of a lien discharge. That's the form 14135. And they want all the documentation relating to that sale. So the contract, preliminary title report, the deed, an appraisal. So all that goes to the IRS, and it's not a quick process. You do have to give the IRS about 30 to 45 days for that to happen. And then simultaneously, it's they give a conditional release. The title company, escrow, will pay the money to the IRS. And then once it closes, you get a certificate of discharge. Last popular thing, I think now a lot of people, since COVID has kind of slowed down, more people are traveling, it's summertime, vacation. So one of the issues now is, people's passports. So if a taxpayer owes money over $50,000 to the IRS, they are reporting that information to the State Department, and the State Department is the one that has the authority or jurisdiction over passports. So it can affect, if you owe the IRS and hasn't paid, it can affect you getting a passport. They can revoke or they can suspend it. So the IRS will send you a notice that they are going to report that information to the State Department. And so, there are some exceptions to that. So if you have a resolution, they're not going to revoke or suspend your passport. So these are some situations. So for example, if you have a payment plan, if you have an offering compromise, if you're in appeal, if you filed a timely appeal, a collection due process, you're in bankruptcy, So here are just some certain situations where the IRS will not send that information to the State Department. But I just wanted people to be aware that that is happening more now, and especially since now people are traveling. So I think that's it for me. If anyone has any questions, please feel free to reach out.
So just wanted to mention that after COVID, the IRS is finally coming. They're coming to people's offices or places of business in our examinations, and collection agents are doing their drop-bys like they used to do. Didn't happen in COVID, but it's starting to happen again. Getting a lot more agents that want to come and do interviews at the place of business and tour them, even if it's just an office. So that's starting to happen again. We haven't really gotten to be able to meet with the appeals officers face to face yet, but soon that will be next. I think they kind of like working from home, so they don't want to do that. But the agents there's definitely a drive for them to get back to that. So be leery of that.
Yeah,
I think I answered all those questions. Any other questions? I'll just verbally go over some of them. Someone said, Tatya said, why don't we set up a group with the Nye Bailey that will do compensation studies? Well, the valuation team has said they would consider doing it. They certainly are capable of doing it. We just haven't had many people that were willing. They've just all been very informal about it. We've published it many times that, hey, let's get it done. I've had clients we've talked to clients about it, and they all just kind of opt not to do it. But we certainly advise them to do it. But in most cases, their compensation has been pretty large. And then the recording requirement, I'm not sure what that means, but what Margarita said was that there's the secret lien. So the secret lien could trump most government other government liens or different things, and anything personal to the taxpayer. But if they file the notice of federal tax lien, that's just like race notice or whatever in each state, that could put you, if that's filed, a subsequent buyer buys it with the lien. So that's why if the equity covers the lien, that's what Margaret is talking about. We try to get it discharged so it doesn't disrupt the new lender.
Right, you want the new buyer to get clear title. And so we need the lien released from the property so that the property can close. And yes, once the IRS files a notice of federal tax lien filing, it basically puts people on notice because it becomes public record. And then the buyer can say, well, I didn't know, because it's public record and should show up on the title report.
Christine asked, is the IRS still shuffling revenue agents between divisions or placing a focus on departments? Well, it's campaigns that they're doing, and the agents like the campaigns because usually you get a bump up in grade or higher pay to do that job, and so they push you into that, and you're just auditing that area. And then the phone line question, I mean, that's just a morass. It's just the phone lines are staffed with new people that don't know what they're doing, and I mean, we have a chat amongst ourselves every day about what line they could get in or not get in that day, and we use a special service called NQ to help us get into some lines. But if that's what you're asking, I mean, it's still just a mess. They're hiring people, but those people I'm gonna take years before they know what they're doing, especially in collection, right, Margarita? It's just, I think the newer the people, the more heavy-handed they are about collection.
Right.
Now, she's talking about the tax exempt. I don't know, Margaret, have you made a lot of calls? I know Kara does a lot to tax exempt or release.
Yeah, that's one of the worst, one of the worst lines to get through. But I mean, it's one of those you just got to keep trying. But yeah, you could be on hold for 2 hours before you get someone on the line.
You can send it to us if you're having trouble with it, and we can put it in our queue. Just have to get POAs. All right, well, thanks everybody.